This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Another edition of the Alternative Investing Advantage podcast. My name is Alex Perny, as always, and today we're very pleased to welcome on Emmanuel Daniel, founder and futurist, or founder of Tab Global and General Futurist, and we're very excited to talk about the changing landscape of the current banking culture, landscape, everything that has to do with it, because there is going to be a very large kind of paradoxical shift in what we normally think of as banking in the coming 5, 10, 15 years. For so long, it has just been a depositor-depositee relationship where you give them money as safeguard. It's better than putting it under your mattress because houses burn down. And the traditional financial markets as we know them to something that is much more decentralized. And for what it's worth, there are going to be some things that maybe aren't in consumers' best interest, but there's going to be a lot of things that are going to really kind of give a lot of power and franchise back to the individual clients, investors, and depositors that are going to be very beneficial. And the best way to do that is to prepare yourself for that is to understand exactly what's going on. So Emmanuel, thank you so much for being on with us today. I always ask our guests to give a little bit of a background about yourself and kind of how you came to be in your current position in life. And it's always interesting when I talk to people on other sides of the planet. I think you're in Singapore right now, I believe.
Well, today I'm in Indonesia, so I travel quite a bit, and they've given me a nice room in the hotel I'm staying in. So very excited to be on your program, Alex, because your listeners and your viewers are people who are already familiar with alternative assets, and in the digital asset space. I'm here to tell your audience that the banks are up to something, and I think we better start paying attention. And my background is that I started something called the Asian Banker in 1996. So I'm an old hand in this industry. And then about 2 or 3 years ago, I was starting to put together a book, and it was my first book on the future of finance. It involved a lot of thinking in terms of what traditional bankers have become accustomed to, imagine that the world will not change on them and stuff like that. And they basically had a negative view on digital assets. But as I was researching to write my book, I realized that a huge fundamental transformation is taking place in finance. And I put my finger on the idea that finance is increasingly becoming personalized. In other words, that the individual is being empowered, and a lot of the transactions that banks perform because they are intermediaries now no longer technically don't require intermediaries. So the banking industry has to reimagine how it wants to play in this intermediation game. So I'm an old-fashioned guy who's now dealing with what the future is creating, and in writing this book and thinking a lot about how the future will come together, I first had to take stock of what is banking, and what about it will be preserved going forward, and then take into account all the other stuff that are being built on it. So you have Sam Bankman-Fried and a whole range of activities on the crypto side and the digital asset side, but that doesn't distract on the general course of the history of finance, and that's what I become about today.
Those are definitely some great points and some things that I definitely want to dive deep pretty well into today. But I think it's always good for us to look at history before we start, as a primer for what we're looking at today. If we don't understand kind of the catalyst for what's going on, then the rest of it doesn't really have a solid foundation. So kind of in your best way to describe it, would you say that this kind of shift, did it start kind of right at the genesis of when cryptocurrency kind of the first white paper started to be issued back in like the late aughts, like 2007 and 8, when we first first start seeing, the white papers for things like Bitcoin come in and start seeing some of that adoption. From the point at which these assets start becoming into the actual ecosystem that we call finance, from then to when did banks start taking notice?
While the Bitcoin story is well told already, in that it started in 2007, and then it just introduced this whole idea that you can have an entire monetary system worldwide, which didn't need an intermediary, and that got rid of the need for central banks. It had its own validation process, all of that. And of course, any innovation, whether it's in finance or in technology, the early adopters tend to be some of the more shady characters. So it started by taking on a nebulous kind of a character or a perception in the marketplace. And the traditional bankers thought that this is a passing fad, that they will be able to ace the process. But today, as you know, the Bitcoin alone is at least $2 trillion, out in the world, and it's become a very stable, version of digital gold, for want of a better model. But there were a number of other developments that were taking place that were contributing to transforming finance as we know it to be. On the technology front, the way in which bank technology was configured and delivered. We started in banking in the 1950s with core banking systems, which are built on mainframes. It takes 7 years to recode a product, and banks had it going for them because there were very few institutions that could invest in the kind of technology that the banks had. And then the technology went downstream a lot, and it became more pedestrian. The hardware, also became a lot more accessible. And today, on a Unix box or even on a PC, you can actually develop banking applications. And it went even further than that, in that the way in which banking applications were being created were no longer armies of line coders sitting there and putting together an application specific to one bank. With open source, any large industry could access new technology and needed to actually access the energy that's out there in terms of technology development. Now, and then that moved on to APIs, open source APIs. And I say this in my book that the banking industry actually missed the API revolution. And what's API meant to do? APIs are meant to enable the little girl that lives down the street access to the banking system by just building a set of codes and then plugging into the banking infrastructure. But what the regulators did was to restrict those little girls from having access to the banking infrastructure because they had this mindset that the data that is in the bank is so valuable that that the bank shouldn't allow its end users to interact freely with the bank. But every other industry around the banking industry, you take a software like Adobe or Microsoft, they're all interacting with their community of users through APIs. There are millions of APIs users out there, and it's a matter of time before the banking industry needs to, be democratized in order to give the outsider access to the institution. Now, what all this does is that it actually weakens the institution itself. It weakens that business of intermediation and turns the table around and puts power in the hands of the end user. And what that also means is that the end user gets to use the institutions in the way that he likes. The end user gets to build applications on his side of the technology. So there are a number of parallel technological developments taking place simultaneously. Crypto is one of them. Open source is another, and then now you have cloud and all of that. which is actually weakening this thing called the financial institution. And regulators are scrambling to see how long they can, keep the whole facade of banking as it is without having to revolutionize it. And so where it's heading, uh, one other development that has taken place is that the more digital a bank becomes, the more like a crypto it needs to behave. So when we saw the crisis that unfolded with Silicon Valley Bank and then Signature Bank and so on, the reason the crisis unfolded was precisely because their deposit bases were digital. It was possible for the end user to go in and do a bank run in 10 minutes instead of 10 days as it used to be. And then banks have to start scrambling to think about how they need to look at their balance sheet and where they can learn best practices from. And as it turned out, it is in crypto that if you take something like Bitcoin, it's 24/7. It provides its own liquidity. It's not leveraged, and it's at face value, and you can build applications on it. And all of these so-called best practices in crypto, they're finding their way into the traditional banking industry. It's the tail that wags the dog. And that's the revolution that we see taking place today.
Yeah, and I think there's a few interesting comparisons you can look at, because you have the whole ecosystem of things, if you will, of the application development and kind of the end user experience that was, developed outside and in conjunction with the banks. The banks ultimately held the keys to the kingdom of how much integration they would allow from that API from the end user, of what they will and won't allow. But you still have, the ability to develop that pretty well outside of that, and prime it with other different interactions with other things that are financial institution adjacent. But the big thing that I always kind of find interesting to look at is that, the banks did focus on that, but the underlying, you're talking about the 50s and 60s with, the big mainframe room with the elevated floors and all that kind of crazy stuff. The mechanism for actual monetary transfer really hadn't changed until the early 2000s. I mean, the ACH system was built out in the 70s, or maybe even the late 60s. I can't remember the exact date that the ACH system was built out. And then the Fed wire system, the SWIFT system, the BIC system. I mean, these are all very, in terms of technology, very antiquated systems. I've told the story a few times here, but my dad used to do, before he retired, did a lot of trade negotiations in Southeast Asia and Japan and Singapore. He would make the joke that it's it could be quicker for me to literally fill a duffel bag full of cash and fly it from Florida to Tokyo than it is for me to send an international wire of the same amount of money for some type of business that was going on. And there was really no kind of examination of how to speed that up to any appreciable amount, which again, the velocity of commerce is a big thing, especially when you have, again, trying to democratize finance and allow people to, deal across borders and deal more freely within a monetary system. The speed at which things occur is a very important factor to that as well. And it's just something that, me having been in finance for the past, going on 13 years now, is something I always thought was just a little bit interesting. Now, to kind of look at what you're talking about of kind of the changing landscape, there's a few avenues that I really kind of want to get some more, your expertise on what you think is going to actually happen. The big one is kind of the technologies that have sprung out of cryptocurrency. And the big one that's, the big keyword is blockchain, right? It's, the ability to kind of self-manage the transactional basis and the ledgers of these particular financial instruments. Again, I say financial instrument because I don't have a better analog to use when talking about cryptocurrency, but kind of the mining of the particular assets, if you will, of things like cryptocurrency and digital contracts like you saw being advented with Ethereum. How are, the banks starting to utilize, adopt, and kind of extract that and use it in their practices forward facing to the end consumer now?
Well, the one thing that banks have to come to terms with is that the whole idea of banking in the future is that you don't need banks, that they shouldn't stand in the way, that you shouldn't need to go to a bank to complete a transaction. And it's the other way around. The banks need to be where the transaction is. So in blockchain, there are two areas where the banks are learning to look for a way to be as part of the transaction, rather than to have the transaction come to them, are in areas like trade finance and financial inclusion. And here, banks have to figure out how they can make themselves relevant to the process of a transaction, going through between two parties or multiple parties in a trade flow, than to have the parties come to the bank, open an LC, a letter of credit, in physical form, and carry it and then present it to each other. And blockchain technology lends itself very well to being able to configure your letter of credit terms and conditions and all that, and carry it in the system without the banks being there. So there's some work underway in that sense, and there are some trade flows which are from in agriculture, for example, coffee seeds in Kenya being graded, and the data being put onto blockchain, and that carries with the coffee seed through the supply chain network to the end user, and the integrity of the transaction is preserved, and the bank pays on the back of that. And that's there is some very good work underway, and that is connecting the most destitute of farmlands out in Kenya or in Tanzania to an end user, which can be a very specific coffee connoisseur in Japan, in Tokyo, or in Australia. And in these two places, I know of specific instances where such programs are running. So the idea is that banking becomes part of society and not the other way around. Now, what it also does is it requires banks to reimagine how they are organized internally. When in the days that we used to go to banks to get these transactions sorted out, the banks had huge back offices. They have teams of 100 people doing nothing but processing trade finance documents. And today, all of that data can be just carried on, can be initiated by the end user, and then carried onto a blockchain process to be able to be completed. So how a bank is configured internally is also very important. In payments, what you mentioned about ACH, the whole idea, if you look at an average payment in the US, there are at least 5 intermediaries for a payment to be completed, a payment transaction. And these 5 intermediaries are actually reluctant to give up their role. And for that reason, they actually resist a lot of the initiative. Like when Fed Now was being promulgated, I think the resistance from the banking industry was humongous. It's like, no, we don't want to give our customers instant access to their cash. The float is important to us, and we have several layers of players to feed in this whole process. But I think the Fed is forcing the banking industry to you guys got to figure this out. And the nice thing about crypto is that there is no back office. So crypto sets the standards, and then the banking industry has to follow or try and emulate that as much as possible.
Yeah, well, I think you kind of bring up a good point there too, is that extracting that control again, in a kind of a utopian viewpoint is ultimately going to be the best for the end user, right? Being able to have that control and being able to have the keys to your own kingdom is very important. But there are some things that banking does. I use the term well to a very high, very, very distant level, but having some of those checks, balances, controls, and regulations helps to keep people safe. It doesn't always work. There's no such thing as a perfect system, but as kind of illustrated by the issues that happened with Sam Bankman-Fried. You have the ability for the worst in people to come out whenever there's anything new and there's early adopters, like you mentioned earlier. So, to have some type of regulatory control, because people left to their own devices, bad things will happen probably at a greater degree than if there is some, like high level controls there. So, kind of moving forward, I think again, all else remaining equal, digital assets and the move towards a more user-driven experience and user-controlled experience is going to be a good thing. But the path to get there is going to have some potholes, right? So from where we're currently at now, where they're just trying to kind of piece together what legislation and what regulations are going to look like with this, how, at least in your mind, would be a good way to go about it? Maybe what are some bad things that are maybe being implemented and maybe some good things that are coming as far as, the regulatory landscape with regard to digital assets as well?
Alex, the big news this week was the Republican Party putting out a manifesto on digital assets and being very clear about what they want and what they don't want. What they don't want is to have a central bank digital currency where the central bank issues a digital version of money and issues that directly to the end user, but in the process is able to be able to audit it and track the transactions and so on. The Bank for International Settlements has already sort of pivoted into the direction that retail CBDCs will just not take off. And I think the U.S. more than any other country in the world has made it a certainty that retail CBDCs will just not fly because personal freedom and personal liberties and so on. But what that results in is going to be very curious and very interesting. Which I say this in my book that the U.S. Will probably take a lead in asking banks or allowing banks to tokenize their deposit base and issue their own version of stable coins, which is a more libertarian version of CBDCs. This whole idea of digitizing finance and then tokenizing it, that's an inevitable path that is already underway. The march is already, going down the street. So we need to put our finger on how banks move from digitization to tokenization. And they're just there on the verge of doing that. And actually, one of the reasons I wanted to have this chat with you was because there's going to be a lot of developments in that area. And that's why I started our conversation by saying that the whole crypto ecosystem is the tail that is now wagging the traditional banking industry.
Yeah, no, and and to the tokenization of deposits, I mean, I don't know. I mean, at least me personally, I mean, I'll levy a personal opinion. I see a lot of, and I'm big fan of history. I find it, many things in history fascinating, but I see a lot of correlation being drawn between like, turn of the century and industrial revolution, like mining towns in West Virginia and the Appalachians, where you would have the company store that issued company, they called them chits, to people that they had currency they could only spend at the company store and they were paid in this currency. Not to the extent that, digital assets would have that, because ideally there would be, an exchange and you could freely exchange those to other, whether it be, a fiat currency or, another digital asset. But, the analogy I don't feel is inherently incorrect or off the mark with that, in that you're going to have private organizations at the end of the day issuing currencies that they have direct control over. And banks, I mean, you don't even have to look far back in history at this point to see malfeasance in banks. Just look back to 2005, 6, 7, and 8, with over leveraged and underperforming assets that were being in the mortgage-backed securities world. So that is a little bit frightening to me, and that's not something I'd even really heard about before you mentioned it. But it makes sense. If the federal government's saying, "Hey, we don't want to have a centralized digital currency," then the next logical step for the adoption of it, is for the banks to now be able to more or less print their own money. They are going to be able to control that supply chain. And then, do you think that there would be regulations in place on the monetary policy of the individual bank saying, hey, you can't just at will issue 1 million tokens, right? You can't just flood the market to do price point manipulation with stuff like that.
Yeah, I mean, as I was completing my book in 2022, I counted there were 16 community currency initiatives in the US alone. And then there were many more in Africa. And community currencies are exactly what you described, which is closed communities that issue their own token that is currency in that community. And in Africa, there's a need for that because there are pockets of destitute populations that cannot make enough money to function outside their local community and don't even have money to pay each other. So they create this community level token that they can exchange with each other. And I actually mentioned one in my book in Kenya, and this community specifically was issuing it in the form of a coupon, and then now they are experimenting with doing it on digital tokens on a blockchain. So the need for community currencies is very interesting, but on this point that you just raised, I'm tracking very closely all of the different types of digital assets that exist today. There are NFTs, there are gaming tokens, and then there's crypto, and there is a rise of any number of alternative models for trade finance and all of that. And all of them have something in common, which is that they tend to circulate around a closed community of sorts that gives the value to the tokens being created and validates each other. And there's a network effect that keeps it, viable and current, and turns it into a currency. So that's what's actually happening in the digital asset space, which is there are closed communities validating themselves by creating a network effect that gives the value to the tokens created. The magic of crypto is not that that Bitcoin went up to 70,000 and all that. The magic of crypto is that anyone can issue a crypto. You can actually go onto Google and figure out how to issue your own crypto, put it out in the market, and then it becomes a question of who will accept it, and will they validate the valuation that you give it. In fact, that's exactly what Sam Bankman-Fried did. He created a crypto out of thin air and gave it a value of $180, and the market accepted it, and then he went out to buy a bank to leverage on that. Okay, so and technically anyone can do this, but the market effect and the network effect is not well constructed yet to pull out fraudulent characters and charlatans and create a stable marketplace. So all of these, and we haven't even started talking about the network effect that gives the value to these assets. That the network effect itself is being constructed. That you need validation from your community of participants that also value the assets that you're creating, the digital assets that you're creating.
Yeah, no, it's, and I definitely want to kind of touch a lot on the network effect part of it, because that's, the driving force behind cryptocurrency. I mean, it's the driving force behind what gives anything value, right? I mean, it's at the end of the day. But that's again, one of the kind of things that is very troubling to me about the cryptocurrency space, is that you have people, especially in the age of influencers and social media. And it's, the what I would recommend any listeners, if you're interested in another good person that examines a lot of this, like a YouTube channel called CoffeeZilla that does a lot of really interesting deep dives on, again, charlatans and fraudsters and people. And it has done a lot on the cryptocurrency space, but the ability for, the classic pump and dump to occur, where you have people issuing all these coins, you have the people writing the white paper that hold a large vested interest, saying it's going to go through the roof, and then dumping their positions on the initial ICO of that coin.
Yes.
And how do you, and the problem is that one of the, like you're talking about, one of the great benefits of cryptocurrency, especially in for people such as the more the poorer communities in Africa that have created the system of trade with it. What allows them to do that is also the same mechanism that allows people to do what the social media influencers that have done some of these huge pump and dump schemes have also done. So finding that happy medium of how do you regulate that without how do you solve the big problem at the top of the hill without affecting the people that have a real need for it at the other end of that spectrum and bell curve? Any thoughts on what kind of regulations or what might help to, again, get a better equilibrium? Because you're always going to have bad actors. You're always going to have people that want to take advantage and steal from people. So how do you kind of edge that in without, shooing the other people off the other side of the roadway?
The regulators started, when you think of what Gary Gensler was trying to do, was that to say that since this is a token that is promised value that is going to be realized in the future, therefore it's a security, and yet that's not the function of a token, which is that to carry a promise on a valuation. The basic idea of a token is that it's a medium of exchange. It should be, right? So that's where regulation started, which is how do we even define this thing? And then you see how regulation is struggling to keep up with everything that's happening. Just in securities, you have the meme stocks, which are the result of the network effect, as it were, right? And when you look at how meme stocks have evolved in since COVID, it was it was a wild west in the beginning, and then now the trends tend to be in shorter cycles, and there are many more. Any one of the assets can become a meme stock, and so on. In my book, what I'm suggesting is that society itself is moving from what used to be a market phase, and it's an idea that I borrowed from a Rand Corporation analyst who wrote this in the 1990s, and I thought it was brilliant, from the markets phase to the network phase. And the rules of the market phase are different from the rules of the network phase. And the rules for the network phase are only just, coming into being. And something the regulators will eventually learn to ride is that the network is its own security. In other words, the best form of safety that you can provide any form of tokenized assets is to let the network stabilize the process. Let more people be interacting on it. Let there be greater transparency on the information available on it, and so on. So, and that regulators haven't figured out yet, and we don't have the mindset of how do we let the network be the regulator. It's a combination of prescribed regulation, the rules that the regulators write, and ascribed regulation that comes from the trends that you see in the interactions. And we're not there yet. We're getting there. When we think about what regulators tell banks to do to keep their banks safe from attacks, cybersecurity attacks, for example, it's no longer a case of keeping your door closed in order to keep your assets safe. It's not the branch banking of the old days. It's, in fact, if you keep your door closed, that's exactly what you cannot do in today's financial services or any industry for that matter. But the question is, how do you keep your door open and yet be secure? and that has to have something to do with the network effect that creates that sense of security. So I think we are still learning. Um, Regulators can keep processes secure by validating the actors. I think that's a first step that makes sure that that the actors keep a good audit report on their assets, on their transaction, keep their books separate, and all of that. But the transactions that actually take place, any number of fraud, instances can happen. So we are in a learning curve on that front. And the more you regulate, when you over regulate, you create a shadow industry. You let the bad actors go out on the side and do a different thing, which is also not something that you want.
Yeah, absolutely. And I think it's, I'm making a lot of turn of the century references to this, but there's a lot of things that can be learned from history, to the point of kind of the meme coins and everything. You have, the patent medicine issues we had in, the early, 1900s to the, 1930s. And then you have the advent of something like the FDA, which again, that's drawing the more of the governmental organization side of it, but you also have people in today's society with the market effect, again, kind of being what it is, and mass adoption of understanding of health in general, of saying, yeah, I understand that, if there's a guy standing on the corner selling me a tonic that's going to cure everything from Alzheimer's to blindness, he's probably, only as good as the air in his lungs. That's about,
Yeah,
it's about as much value as what he's saying.
Yeah.
Yeah, and
But
coming into that, you're going to see people adopting it much better and understanding that if something is too good to be true, then it probably is. But the problem is we're such a wild west, still to the point where you see these wild swings. You see people becoming millionaires overnight. That people really want to get in on that, right? That's just kind of what I a little bit of an analogy I kind of drew from what you were
Yeah,
saying.
no, it's funny that you mentioned medicine, because the first case in contract law, and I studied law, is the carbolic smoke ball, right? So it's like, and then the legal system, puts all the elements of a contract from that. What's interesting is that all of this is going to be accelerating with quantum computing, with AI. And so we just cannot manage it in the traditional way that we've become accustomed to. So one of the stories I tell in my book is, in 1903, when Henry Ford, released the Model T out in the streets, all the rules were stacked up against, the combustion engine car. Okay, and because they were noisy, they startled the horses, they damaged the roads, they were slow, and it was a luxury item. It wasn't even comfortable. But as the automobile became faster, quieter, more comfortable, and all of that, then the regulations just fell by the roadside, fell by the wayside, right? So that's actually what's happening in regulation right now, pertaining to all the impact that both crypto and AI and all of this is creating in finance. That a lot of the regulations are directed on this innovations taking place, not realizing that the innovations will just keep multiplying, and that we will not be able to handle them in that way. So but they will create new patterns of reality that's where we will find the certainty of the relationships and so on. We are in such a transition. In fact, that's the title of my book, which is The Great Transition. The personalization of finance is here. So the thing is to figure out where the inflection points are going to be, and what are the decisions that we need to make at those points. And right now, the US is in an inflection point, because I'm not a fan of either party, but here you have a right-wing party, writing a manifesto on a left-wing idea, which is the liberalization of finance through tokenized assets. So I think that we've reached an inflection point. We're just at the cusp of banking taking on the disciplines being created in crypto and internalizing it. And that's what's going to change finance easily in the next 10 to 15 years.
Yeah, no, I think that's kind of a good place to start trying to bring this in for a landing. Is that the big inflection point we have right now? Because over the past 7 years, there's been small chips being taken at the attempt to regulate the cryptocurrency markets, and you have some people taking big swings, like South American countries, buying billions of dollars of cryptocurrency and trying to base their whole currency against it. I think that might have been a bit premature, but again, you have people that are really swinging for it, people taking small chips, but it's gotten to the point again of inflection where there is going to be something. It's going to have to be meaningful in the government's eyes, and I think for the end consumer too. There needs to be something that happens to kind of rein in a little bit of what's happening. Again, I think we're heading in the right direction. I don't think we necessarily need to take a hard left or a hard right. Considering that general meandering in this direction is good, but again, there's too many things happening on either sides of the bell curve that need to kind of be reined in. We need more people to adopt it, which needs to have more security and faith in the markets in general, which involves getting rid of the people that are doing the Sam Bankman-Frieds and the meme coins and the pump and dumps and the market manipulation. So again, that's that's kind of what needs to happen. Any closing thoughts on that? And then also, again, I would really love for people to know how to get in touch with you. And you indicated that you did write a book as well. How can people find that as well?
Right. Closing thought. Remember, I said this, that governments always revolutionize the finance industry in times of stress and out of desperation, and never out of purpose. Remember, I said that, okay? Because when we look at what regulators are doing all around the world, it seems like as if that they are curating finance in a way that is sustainable and there's something that they can control. But as we saw when the gold standard was dropped, was just because the U.S. wasn't able to sustain its hold against the price of gold, and Nixon just turned up and said, you know what, we're going to float our currency, and from that day onwards, the world standard is a floating regime, and in that same way, it will be the regulators out of desperation, and some of it is geopolitical because there's a need for the dollar to be a global currency, and in my view, that's only going to be possible if they digitize the currency. So that's a conversation in itself, but that's closing thoughts. Yeah, I'm Emmanuel Daniel. I have a web blog page, which is my name, and from there you'll see my book and some of these random thoughts that we just discussed today.
All right, fantastic, Emmanuel. I really do appreciate you taking your time out of your day to speak with us, especially from Indonesia, which is clear on the other side of the world from where I'm sitting at in Florida here. So again, the most valuable asset we all have is not digital, it's not monetary, it's not gold, it's our time, because no matter what we do, we can never make any more of it. So thanks for spending some time with us today. I do really appreciate it. With that said, my name as always is Alex Perny. This has been the Alternative Investing Advantage podcast, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.